Thank you for being here. Welcome to NAAIM Confidential, episode 27. Awesome background. I'm this week's host, Ryan Redfern. Today we have Ted Lundgren from HG Capital in Houston, Texas, who's such a trooper. His power is actually out, and he's at a friend's house. So he's really committed. I appreciate that he's making it here today.
Thank you.
Oddly, I'm here in Austin, and we're getting a storm rolling in too. So hopefully my power stays on for this whole thing. But that's where we are right now. So Ted, HG Capital, former president of NAAIM.
That's right.
Certainly one of the people that I first got introduced to in NAAIM. So it's great to know you. Certainly somebody who's been a positive influence on me in this group. So thanks for being here.
Thank you. Thanks for having me.
Absolutely. So let's start off as always with the NAAIM exposure index.
Yeah.
Grab that. Here we go. Should be sharing it. Current number is 93.84. I know I reported higher. I think it was 110 this week. So I was pulling this up this week. So there's that. And Ted, you don't contribute to this number, right?
We used to, and
okay.
But we change so frequently. I thought, am I skewing things? Because it just depends on the given day. We may be long or short, or we stayed long today, but I have recently started going more with a tilting type thing because I have a tendency not to miss some of the upside, be scared of the markets. So, and that's the main reason why I do a lot of this stuff is to have some kind of proof to back up and make me feel better about getting in. So when I'm looking at this, and I remember Will Hepburn talking about getting this together.
Yep.
Probably before you were born, Ryan.
No, not quite, but thanks.
Yeah. But it was quite a while ago, and it was a great idea. He was so enthusiastic about it and excited. And as you know, it's difficult to get a herd of cats to move in the same direction. And when was this first launched? Susan, do you know? Are you there?
13, I believe. 2013 was when it was
2013. Launched. So
about 10 years.
We didn't have a birthday party for it or something? 10-year anniversary?
Maybe. I don't know.
It is interesting though, because I don't know about you, but I really feel like the market is very extended.
Oh, absolutely.
Yeah. And those corrections are sharp. And at what point do you bail on something like that? And I know there's been a lot of people that have used that as a sentiment indicator. I've heard you talk about it before.
There are.
Good. And it made me start thinking about something in particular. And you like moving stuff, so I'm going to show you. You've done that.
There are people who use it as a contrary indicator,
right?
Which is kind of funny because I know it's a static number from Wednesday's close. So where I was allocated on Thursday was different from this. So it is what it is, but it is funny to watch it change in people's perception of it. However, it is also by far the most viewed page on the NAAIM website.
That's definitely true. Yeah,
we get around 9,000 views per week on our website from this indicator specifically. Yeah, it's wild. And same with Twitter.
And you can download the data.
We can now, yeah.
And use it in your own research.
That is correct.
Well, I'll be doing that soon. I was looking at that. I was looking at that type of thing, and I always like, again, to have data to put in there. But those visuals are so important. Matter of fact, and this is not something you've seen even when we were practicing this, but I will share something with you.
No, absolutely. The next segment is to dive into your process and things that you think about when.
Okay, yeah, stay on track.
Yeah.
I'm glad you're doing.
So what do you got? What do you got for us, Ted?
Well, 2022 really hurt a lot of people and surprised a lot of people.
Yep.
And so I started scratching my head and thinking a lot differently about everything. Most of the things that we did and the people in NAAIM know us for is being a sub-advisor. So in an individual program, and you don't have much control over the client if they're just in one program that does one specific thing. And that's usually how you're used as a sub-advisor. And I've taken this more holistic approach lately. And with the bond market going up like it did, or I mean, the yields going up like they did,
Right.
That opens a door to a lot of old school type management of conservative portfolios. Mm-hmm. So I have a book business as well, and those clients are in that distribution phase. So that's really important.
Yeah.
And then at the same time, so you don't want everything to collapse on you. So I can have some laddered treasuries and laddered high yields, and even hedge them by going out on the curve a little bit and doing an inverse high yield in case things do blow up. But then forcing myself to be a little more aggressive in the correct portion for people. So really looking at the timings of their distribution and building the whole portfolio. And that logic works out really well when you actually disaggregate the whole portfolio and show them what pieces are doing what job. This one's doing the heavy lifting. This one's the safety, on either side of the spectrum, and how they're balanced and the reason they're balanced that way. Then you don't have as many problems with somebody having gain regret or capitulating.
Right. And I think that's pretty common in NAAIM, is that we're really good at being defensive, but it's a little bit tougher to be aggressive. And that's also a trade-off of being active. Sometimes you can chop most of the downside off, but you're not going to get all the upside. It's just the trade-off of the game.
Absolutely. And so it's funny you'd mentioned that too, because I miss out on some of those things, but I mean, I would like to be able to have a foot in the game, So since 2022, I started looking more at market regimes and trying to define those market regimes instead of, a buy-sell signal, more a rules-based system. This is a rules-based system, but it only has one goal: it's to participate in the market when there's a trend, or when it's overbought, you dollar cost average out, or when it's oversold, you dollar cost average in. So there's all these different market regimes, and they don't work great all the time. And that's a real shift in thinking from being a sub-advisor, because if you don't work great all the time, you're not going to be a sub-advisor anymore. But when you mix all these things together as a family, then, and use leverage when they do work, I'd be sitting in cash for the longest time until the environment is right, and then lever up as we go. So a combination of those things are what I'm using on the more aggressive pieces of the portfolio. Sure. And so I might start participating again by telling you, okay, here's my position, because it doesn't switch much. I think we're like 134% long yesterday or something like that. Somewhere in that area. But it goes anywhere from there down to like 33. Yeah. So you can use that leverage. So I don't know if we're in a choppy market or we're obviously in a trending market, but all of those components are in there just in case.
Gotcha.
Yeah.
So you're looking at all the components, all the styles at once, and determining what's most optimal for the environment. Right. What's acting the most ideal, I guess.
Yeah. And I'm always, and as you are, always looking for something else to give us an edge. I mean, that's real important. And most of my clients are engineers, things like that. So they're very technical in nature, and they like moving charts like you do. Yeah. And it's really difficult. But Laura, right, does a fantastic job with sitting down with just everyday people and just talking to them. Like, here's what it's real simple. I'm not going to tell you about, kurtosis or skew or, any of that. Yeah.
Eyes glazed over.
But that's the stuff I love,
Sure.
It is. I mean, and that's why being the sub-advisor was a heck of a lot of fun, because you could sit down with these managers that understood, or these advisors that understood what you were talking about and loved it, and they can raise money for it.
Yeah, absolutely. It's a different environment. I mean, it's a different audience. You're telling a different story.
Absolutely.
Something they have to pass on. To go back to the moving dots that you loved, I know you had one of the first things I saw you do years ago was make that a moving dot target of the efficient frontier and how it's not static, and how people are like,
Right.
oh, the efficient, it always has this same curve. But the reality is it is all over the place
Oh yeah,
continually.
absolutely.
And even decade by decade, if you layer it on top, it's like you get completely different results. So people who use that really, I don't feel fully understand what that thing is doing. But I think you have a great example of how that
You want to
works.
see that, don't you?
I'd love to see that. Can
Let's
you
see
make
if
it
I can get
happen?
it to work. Um, I had it both in a PowerPoint and it was generated off an Excel sheet. Very, I'll share it this way rather than the whole presentation.
Yeah,
And
sure.
then I've got something else that I'll show you that I think is pretty cool.
Perfect.
That also moves.
Well,
So
then
let's see. I have to
sounds
go
like you're on the
here.
right track.
Yeah, I'm still working out of my suitcase, as I say. So I've got to make sure that this is not my normal environment here.
In a fish tank.
There it is. All right. So can you see that?
Yes, yes. Now I
All
can see
right.
that.
Um,
So
so
what are
this,
the
the
dots?
efficient frontier would normally be something that you'd see static, right?
Mhm.
So if this is risk on this axis and this is return, both positive and negative, the efficient frontier would almost always, you'd see it as positive because the market has an upward tilt to it,
Sure.
right?
Yep.
In reality, so that's 2008. You can see there's just segments of time moving, and the orange is the S&P,
Right.
and the blue is a portfolio that we are managing. And to give somebody the sense that just because that dot's up at the top, there's going to be times, especially in 2008, 2009, that type of thing, where they're not going to behave perfectly.
Mm-hmm.
But at the end of this, and let's see if I can, it moves around for quite a bit, of
Mm-hmm.
course, speed it up some. There's 2010, so those segments of time, I believe they're 3 months at a time.
Mm-hmm.
The idea for a conservative portfolio, anyhow, is to stay within this box.
Mm-hmm.
And the efficient frontier, if you had an aggressive one, it would be just stay within this box, that type of thing. We all know what efficient frontier is. So over time, that these dots just move around like crazy.
Yep.
And it gives you a good visual to understand, what volatility really means.
Uh-huh. There he
And
goes. That's great.
at the end of this, I just couldn't get that to work. But at the end of this, it shows you, wow, what's that?
There
There
it
it is.
is.
There it is.
There it is. Yeah, how they're just all over the place.
Yeah. I mean, that's the truth of it right
Mhm.
there.
Yeah.
And it is that it's just a big spaghetti plot. So I did not have that prepared for you, but I'm sorry about
No,
that.
that's
But
okay.
I do want to show you something else that I do have, because I was thinking about, and this is the kind of the fun stuff for me anyhow. I was thinking about how it's easier to understand concepts sometimes, not that one, but
Oh, that's cool.
yeah, this is a three-dimensional chart of I'm not joking at this point, skew, kurtosis, and a risk return ratio.
Okay.
And I'm looking at an individual like the TLT, for instance, and we're right before the interest rates start to go up, right?
Mhm.
So when you see these little buildings that look like Sim City,
Yeah.
this is when the kurtosis is in to your advantage.
Mhm.
Okay. And when we see, let's see if I can do this. Yeah. When you see the underbelly of it, or the holes,
Mhm.
like that,
Okay.
you don't want to be seeing that,
Right.
because there's not a lot of validity to it. That's where you get the fat tails, the distributions that are fat tails.
Sure.
So looking at this, I found this really interesting to be able to look at this through time, because at that point, it can give you some ideas about, hey, something's changing, right? And just prior to this, and this is a manual little click, those buildings start to disappear. And you can see the holes forming almost like sinkholes. And this is the in sample. This is what we're actually looking at. And this is the out of sample. Okay. So what happened the next 3 months or something like that? And this is TLT. But just being able to represent the data in a visual way can give you some ideas about building these programs that do have if-then rules. Does that make sense to you? Do you understand what I'm
definitely.
saying?
And I know you're very rule-based and risk on, risk off kind of thing in a very, very pure sense, more than many in NAAIM are.
Yeah.
I think you're probably more the purest in that sense.
Well, I used to be, like I said, and I've taken on more of a holistic approach.
Right.
But it's these kind of things that I get jazzed about. I love it. It's fun to play with, but also when you run through these examples and you know what's coming up, well, you can see it. It is already developed, and you have these sinkholes starting to develop. So I don't know if there's anything to it, but it's a good way to look at data and information that you wouldn't normally look at that way, right? So I showed you before I started this, we had kind of a flat underbelly. Now we've got some pretty ugly peaks in that area. Yeah. So from that, you can get some ideas. And I thought about taking that data with NAAIM's the exposure index and seeing what we could see with stuff like that too.
Oh, interesting.
That'd be interesting, comparing it to the actual market and comparing it in this sort of way, so you can see the complexion changing of the portfolio of in this case TLT, as you run through time.
So do you use this in decision making, or is this more just reviewing how the index
I built this for you, Ryan.
Thanks.
No, it's just a different way to look at the data. And I don't use it in decision making, but I'll use it to find little nuggets of aha moments, if that makes any sense to you.
Sure. Well, do you have an example? What was an aha you got from this?
If it could be because of the Zoom call, but it's kind of choppy. But if you can see, I'm moving through the dates, and these are almost like they have a predictable. The wind blows from the northwest corner down to the southeast corner. And then they'll start changing direction, and then it'll blow diagonally the other way. So as you move through time, it is a change in a market environment. I mean, we obviously knew there was a change in the market environment, and this is the data that shows you, at least visually, of what happened during that time. And it looks like hell.
Yeah.
I mean, I think of this as that Sim City. Would you want to live that place? You just trip and break your ankle in one of those holes.
Yeah, looks dangerous.
Yes, absolutely. But it tends to go, well, if that is the case, I find a general tendency here, then you can put it into a formula and do your walk forward study. And you'd be able to tell if there's any validity to it or not. But just by looking at data in different ways, you got to continually do that. And you might be able to find some things that show up and you get ahead of the curve. You have to know what they mean. But the bifurcation in the S&P that we've experienced with the equal weighted S&P.
Oh, yeah, absolutely.
That was another thing that I was working on. So I'm always trying to find something and where it would fit in that sleeve of Fishing Frontiers. Which little box am I managing for? But that I thought was really interesting, because there are the two indices that you can go back to 1990. And I can show you that too, which is another thing I made for you. And there is a way to use some of these same ratios. I heard you talking about those in some of your calls.
Yep.
Because that's all this is a representation of a three-headed monster ratio.
Right.
Your average return over your standard deviation is the one constant that I put up here.
Right.
And, during this period, of course, it's very negative. And then the skew and the kurtosis tells you something about the distribution and how it's behaving. And obviously, that's the one thing that I can so far glean from this is when your city looks like it's a giant sinkhole, it's not a good time.
Right.
And I've just looked at a couple of different things like the S&P and that type of thing. However, see if I can find that. I'm going to stop sharing for a second.
No, sure. Based on what your data says now, are there any insights you're getting about where we are in this cycle? As you said earlier, we're kind of peaking. I think we are too, but could you show that, or how does that represent it to you?
Yeah, let me see if I can find what I was working on. Again, everything is all over the place. Yeah, I had to bring my actual desktop over here, so I went and got it yesterday. So that's where, because the laptop won't handle some of these things.
Sure.
But the SPY and the
RSP,
these two. So again, using those ratios, which is just the average of 20 days over standard deviation.
Okay.
And then looking at the delta of those things, you can see historically this jump.
Yep.
And it's pretty dramatic.
Oh, so that's
huge. Yeah. And the thing is that you can see it on a chart here too. And I would guess, let me look at one other thing. It's probably on. It's not the exact one I was looking for.
Gotcha. That way. Well, that reminds me of yesterday's ratio between was it small cap and NASDAQ? It was like a 5.5% spread. It's never happened.
It's just changed. Yeah. It was crazy.
So we're certainly getting skews when you compare data in this way, which is fascinating. I'm not completely sure what to do with it, but it's really interesting to spot and say, well, this never happened.
Yeah, it is. But and the one thing that I did do, though, if I can find it, is take that a step further.
Okay.
And so when you look at a longer term trend of what that really should be, it ends up having a kind of an oscillator effect.
Sure. Well, I would think mean reversion is what I'd be looking at.
Absolutely. Yeah, absolutely. And for whatever reason, I'll see if I can find the other one, but I did take it and went one step further with it.
Okay.
And used that mean reversion to switch from one or the other. And
so when you talk about
it actually worked pretty well, but it's not one of those things that's going to knock your socks off, but it's going to keep you in the market. And in a day like or a year like this, we actually oh, here we go. I know why I didn't find this now. This is how screwed up things are. I even have a little folder for you. And I forgot all about it. What an idiot.
Yeah.
All right.
Well, I was going to say, going back to, is this one of those things you use when you talked about different market regimes and different,
yes.
Okay. So this is how you go mean reversion to time versus it's a trending time. And this helps you define which you're dealing with.
Right. Okay. So this area here, what are these dates? Can you see that?
Yep.
Okay. So what's that?
It's tiny, but yes, I can see it.
Let me see, man, make it a little bigger.
Perfect.
This is that the green line that's moving about is the delta between the two.
Okay.
All right.
And this is S&P and equal weight.
This is the equal weight, and
weight.
that's the S&P.
Right.
And this red line here is the program that I thought, well, you like this, hopefully, and that I came up with. So the next thing to do here, oh, I know that. Now I know why. Is you can see the performance over a long period of time in the orange one. That's the equal weight.
Yes.
And it performs so much better than the regular S&P.
It does, and most people don't realize that, especially now when the cap weighted is doing so amazing because of the Magnificent Seven.
Right.
But it's not normal.
So this is a clearer picture of what I'm talking about.
Okay.
This is that's 2021, but you can see it just getting nutty. And that's the delta between those, and not looking at just the return. I'm looking at how efficient is the return.
Sure.
How good is that return? How smooth is it? Because when you look at one of those ratios, that's what it can tell you. If I have a great rate of return, but I have to take a lot of volatility to get it, it's not necessarily a great investment.
Nice.
Right? Because people will capitulate. They'll just give up.
Yeah.
So this is the entire history of it. Mm-hmm. And you can see a couple of times where it goes the other way.
Yeah.
But this is, right up in here. And most of the time it's fairly quiet.
Yeah. But
when you start to look at the actual returns from this, mm-hmm. being able to, when this is performing above here, you're in the S&P. Below here, you switch to the other. It's that simple. This is really that simple. And the returns on back from 1990, they're not necessarily going to knock your socks off, but you know what? You're going to be in the right environment at the right time.
Exactly. And that's really what it's all about in the end. Yeah.
Mm-hmm. Yeah.
Nice.
I mean, it's kind of splitting the difference, really.
Yeah, absolutely. No, we're right about at time. So I got to ask you, what's your favorite investment quote while I still have you?
Oh, Warren Buffett used to say, if you want to make money, hold your nose and go to Wall Street.
That's a quote?
Yeah, I
can't say I've heard that one.
I think it is. Yeah.
Nice.
It was in a long time ago when there were still brokers and those type of things. But it was really important because it's frightening to me that people were investing money for my parents, for instance.
Oh, sure.
And not not really caring. I mean, the idea of somebody on Wall Street was really an uncaring person that they didn't just want to make money, and that was Warren Buffett's, quote that I think it was in Fortune magazine or something like that. They did an interview with him.
Well, nice.
Yeah.
And then finally, how does somebody get a hold of you if they want to learn more about this crazy charts that you build?
HGCapitalAdvisors.com.
Perfect. Are you on Twitter, on social, anything like that?
I'm not. My wife's been trying to get me to do more of the LinkedIn stuff.
Okay. And it's a good place to put up videos.
Oh, it's fantastic. Well, yeah, I didn't realize that, but I could do that.
Yeah.
And after some of these things get a little more refined, but there's a couple of things that I built here over the last, during this hurricane. Post-hurricane is worse than anything else. And you're not seeing the screen now, or are you?
Yeah. Watching this train go by.
Yeah.
We got to wrap this up now.
That's those things. Yeah. Let's go ahead and wrap it up. But I just wish I was a little more organized for you, right?
No worry. We saw some good stuff. We looked at some neat charts. We had a good time. It's all good. Thanks.
All right.
Ted, thanks for being here. I appreciate your time today. And I'm sure I'll see you soon. We'll have to have you on again, and we'll go we'll call it a completely different route next time.
Well, I hope so. I hope there's no natural disasters happening.
Absolutely. Well, thanks for still making it. I appreciate you
All
being
right.
here.
You bet. See you.
Thanks, Ted. See you next time.